Okay, thank you very much for joining me. Sorry about the slight delay there, yes, so I'm Fiona Cincotta, Senior Market Analyst here at City Index, and you're joining me for the weekly look ahead for the week starting the 22nd of January. So just before we start, I'm just going to ask you to take a quick look, to take some time to read through the risk warning, and I'm just going to put myself on mute for a moment whilst you do that, and then we can crack straight on. Okay, so what we'll do is we'll just take a look through the economic calendar and highlight which are the main tradable or main trading events that we'll be watching out for next week, then take a look at relevant markets and how they are performing and what sort of trade setups we might be looking for. Obviously, if you've got any questions at any point, then please do ask as we go through. So let's just start. I'm just going to bring us to the, here we go, the economic calendar. This is our economic calendar on our website. And just starting, I filtered it for next week, and I've also filtered it for the high impacting events. First up next week, that's going to be really interesting to watch, will be the Bank of Japan interest rate decision. Now, the central bank is not expected to change its interest rates or its monetary policy stance. I think it's going to be a really interesting one because obviously if we think about where we were in the last meeting, that was when the sort of Bank of Japan had sort of started to hint that maybe it would be looking towards changing its interest rate position, maybe a move away from negative rates and a slight hawkish pivot. And that's what that's what sent the yen charging higher against the US dollar, which at that time we saw those sort of, dovish Fed pivot bets coming in, and it sent the US dollar Japanese yen sharply lower. Let me just pull that up in the chart so that we can see it. Here we go. This is what I'm talking about here, this sell-off here. Now we've had this reversal, really quite a steep reversal, and that's been on changing expectations. Basically, we're not, the market really isn't expecting the Bank of Japan to do a hawkish pivot anytime soon. That's after we've had the New Year's earthquake in Japan, and also as data just generally hasn't been pointing to that way. We had inflation figures out again overnight from Japan. They came in weaker, they're cooling. So we've also seen that wage growth has slowed and household spending is also weak. So there isn't really anything there that's providing an impetus for the Bank of Japan to go ahead with the hawkish pivot right now. It's just interesting having a look at, there we go, bear with me. There we go. Sorry. Bank of Japan expectations of when the Bank of Japan is actually expected to see a policy pivot. And according to a Bloomberg survey, then April is looking to be the month, the interest rate decision at the end of April. And that's basically because there's some spring wage data. The spring wage hikes are expected to come in above the 30-year high. Now, this was a prerequisite they were to set in order for that hawkish pivot to occur and for a move away from negative interest rates. And that's why sort of April has become a key focus. So what does that mean? That does mean that potentially the Japanese yen could remain unsupported against the US dollar, which, I mean, it has run really quite significantly higher from that low of 140.25. It's taken out the 200 SMA, the falling trend line support there, and it's also taken out the 100 SMA here. So, you know, I think as far as bulls are looking for, they're going to be looking for a move up to that 150 level. On the downside, immediate minor support can be seen there at the 100 SMA around the 147.60 level. Below there, I'd be looking at this level here, the 146.40, and below here, then we've got the 145, which was the July high, as the next level to be watching out for. Obviously, with the Japanese yen and the US dollar, we're talking about the yen and what's moving there, but there is obviously a lot of movement as well coming from the US dollar. We're going to talk a little bit more about where the Federal Reserve are and what that means for the US dollar as we move through. But we have seen, you know, solid data from the US this week, and we've seen Federal Reserve officials push back on hawkish on a rate cut soon, and so that's, you know, helped to lift the greenback against its major peers this week. It's set for a second straight week of gains. So let's carry on, see what else we'll be watching out for next week. Other ones to look at here, this is on Wednesday now. We've got PMI data. PMI data from Germany, I think, is going to be very much in focus. You know, have we reached the bottom of you know, the downturn, as it were? You know, we've had some really weak figures from PMIs at the end of last year. Look, the manufacturing was down at 43.3. Is expected just to tick a little bit higher, but let's keep in mind 50 is the level which separates expansion from contraction. So, you know, there's still a long way to go till manufacturing sector gets anywhere near to expansionary territory. The services sector is looking a little bit stronger there. We can see that that's just below the 50 level. You know, if we get some weakness in the data here, this could be a case of weak data sort of fuels the expectations that the ECB may cut rates sooner. Now, that's going to be beneficial, for example, for the likes of the DAX. So let's just take a look at what the DAX is up to. Bear with me while I find the one that I use. Here we go. Okay, so this is our DAX chart. It's been really interesting because obviously the DAX has had a massive run up, despite the fact that the economy is pretty, well, is heading for a recession, most likely in the second half of this year. Sorry, it's going to fall into recession in Q4 expectations. As I said, you know, that PMI data has suggested that the German economy is relatively weak, and is in contraction territory. Yet despite that, we've seen this run up in the DAX, and that's basically, you know, on those expectations that the ECB and also the Federal Reserve will start cutting interest rates sooner rather than later. Now, obviously, that was the run up in November and December. We have since this week particularly had central bankers really, you know, trying to guide the markets and really push back on those early interest rate cut expectations. And that's, as a result, had a negative impact on equities across the week. Whilst equities are up yesterday and just slightly today, they are set to fall across the week as the market sort of reins in those rate cut bets. We can see here on the DAX, I mean, it's been trending lower. It's fallen below the 20 SMA. found some support here. This is an interesting one on the 50 SMA, and it has rebounded higher. So right now we're seeing it trading caught between those two levels, caught between the 16,400 and the 16,660. We'll be looking for a breakout from one of those levels. I mean, that slightly higher, that slightly longer wick there might suggest that there isn't much demand at the higher levels, but still that wick is still relatively small. It's not sort of as extensive as this one here, for example. But if we do get a breakout above that 16,660 level, then I'd be looking for the 16,800, which was the high that we saw last week, before we sort of bring that 17,000 all-time high back into focus. On the downside, we've got this minor support here. That's the 50 SMA, which just caught the sell-off yesterday. It's around the 16,400 level today. If we do see a breakthrough there, then I think, you know, that 1600 round number is going to be important ahead of the 200 SMA, which is around the 15,900 level. So that is the DAX. Now we'll just go back to our economic calendar and see what else we've got going on. Do you know what we've also got? I haven't really prepared too much about this, but the UK data I think is going to be interesting, because, do you know, like, we've seen that inflation data came in stronger than expected this week. We've seen retail sales slump today, but we are seeing that the service sector in the UK is holding up relatively strong. So we can see here, you know, last month in December, it came in at 53.4. So the level above 50 is growth. 53.4 is suggesting really solid growth. And, you know, manufacturing is still obviously disappointing down there. So it's a pretty mixed picture that we're getting from the UK economy right now. So we've got weak retail sales, we've got sticky inflation, and yet we've got that service sector which seems to be holding up pretty well. So is it still holding up well as we head into the new year? That's going to be what we're going to be watching. As we can see, the sterling US dollar, sterling's held up better against the US dollar than perhaps some of its other major peers, such as the euro or the yen. And that's basically because of this sticky inflation that the Bank of England is not expected to start cutting interest rates before the Fed or the ECB. And I think particularly, you know, given that service sector inflation as well is still pretty sticky with that growth and expansion going on in the sector. So as we can see here, the pound US dollar, again, it's just found some support there on the 20 SMA at the 50 SMA at the 126 level. It's risen higher. It's now testing support there at 127, which is the 20 SMA. If we get a rise above that and continued strength, then 127.80, that's last week's high, ahead of 128.30, which was the high at the end of last year. Failure to get above that level there at 127 could see a retest of 126. But look, this 126 level has been holding pretty well so far. So that's going to be what we'll be watching out for. If we do get a breakthrough 126, it's going to expose the 200 SMA around the 125.50 level. So moving on, there is quite a lot as far as economic data is concerned next week. There's got an event. There's quite a lot to be getting a head around. Then another Bank of Canada interest rate decision. Bank of Canada is not expected to change with interest rates. They're expected to hold steady around that 5% level. We have seen there's been a little bit of a tick up of inflation in Canada, and we've also seen, though, but you know, the growth is perhaps starting to show some signs of slowing. But for now, you know, the Bank of Canada are sticking with their position. The market's potentially expecting a rate cut there. I believe potentially starting to price one in as from March. we'll have a look at the USD CAD. But the other thing to bear in mind here, oh, bear with me. There we go. Oh no, that's not it. One moment. Maybe that is it. Okay, so there we go. That's what I was waiting for. We can see that the again the CAD has had a pretty sorry, the US dollar has had a run up here against the CAD, and that's basically to do with the weakening as well that we've seen in oil prices, and also the strength that we've talked about in the US dollar on the back of that strong resilient data, and the Federal Reserve officials pushing back on rate cut expectations. That the price faced rejection there at the 135.30 level, sorry, 135.40 level, and it's just been falling lower over the last few seconds. So have a look there. That pretty long wick on the candle suggests that there was quite weak demand to push the price higher. Just testing the 200 SMA there at 134.83. If that level holds, then we could be looking for a retest of that 135.50 level. And if it does break, then I'm going to be watching out for this level down here, the 133.75. It's going to be the confluence there of that falling trend line with the September low. So that's going to be another level that I'll be watching out for. Moving on, another interest rate decision, this time from the ECB. ECB are not expected to change interest rates, which currently sit at 4%, a record high. We've had a lot from ECB policymakers this week, and including ECB President Christine Lagarde. Now, the ECB are not expected to cut, as I said, but the market had been fairly aggressive in its pricing for rate cuts from the ECB this year. That has been toned back a little bit, dialed back a little bit. But I think what we're seeing with the ECB and what's come out from the ECB commentary at the Davos World Economic Forum is there is this sort of ongoing clash, isn't there, between the hawks and the doves at the central bank there, and that did come out a little bit at Davos. It does seem that the hawks still are ruling the roost. You know, we had Villeroy saying that it was basically too early to start thinking about cutting rates, although inflation is on track and it is on the trajectory of cooling. And then you had Centenario, who actually said that, well, now we could start talking about cutting interest rates. So I think those comments really did highlight for me the differences between positions at the ECB, which I think may become more apparent now as we move closer to that 2% target. However, ECB President Christine Lagarde is reiterating her position that, you know, the fight has not been won against inflation, and that there is still more work to be done. So even the ECB minutes from last week, there was no discussion over interest rate cuts and when they might start. However, ECB policymakers did sort of voice their concerns over the outlook for the Eurozone economy. So that's going to be interesting. So we're going to be watching for, you know, suggestions that concerns over the economy are building, in which case that may see rate cut expectations being brought forward. I mean, if we just have a look here, this is from Bloomberg. First rate cut is being priced in there. Just, oh gosh, sorry. So, and 4 rate cuts are now expected across the year. That has been toned back from a more aggressive pricing of rate cuts at the end of December. So off we go. Let's have a look now at the Euro US dollar. Okay, so we found some support here. Okay, so it's been trending lower fallen lower, had sort of a heavy fall across this week until it found support there on the 200 SMA. Couldn't break below that at 108.45. So that's going to be the key level for sellers to need to break through in order to extend the sell-off towards the 107.50 level, which is this level here. You've got the 100 SMA there. It's also a level that sort of offered support and resistance at various points across the year. If that 200 SMA does hold, we've also got those long lower wicks that does suggest that demand was weaker for sellers at those levels, and we can get a good rise over this sort of 108.90 level, 109, then a recovery is going to be looking back up towards the 109.70, 60, that's the 20 SMA, in order to address the 110 psychological level. I'm just conscious of time because it absolutely flies, but we are just now moving on to the last bit. I won't go into consumer inflation in Japan there, because obviously we've got the Bank of Japan that we've already spoken about. So that means that the data may be a little bit less market moving than normal. Core PCE, the Federal Reserve's preferred gauge for inflation, cooled 3.2%. Will we see a continued falling in December? That's the big question. And considering that we saw an uptick in CPI, will that same uptick be seen in core PCE? The other one to watch out for as well as core PCE will be personal spending. If we're still seeing personal spending that's not strong, then that's going to support that soft landing narrative, but it also may mean that, you know, getting to that 2% target for inflation will be that little bit harder. Don't forget, we saw US retail sales this week come in stronger than expected. And I'm just going to show to you what we've got repricing at the moment on the CME FedWatch tool. 55% probability that the Fed will cut rates in the March meeting. So that's down quite considerably from around 75% just a week ago. I'm just rushing through because I am so conscious of the time, but let's have a look at a couple of charts. I think the first one we should be looking at will be the Nasdaq, just because we had that record all-time high yesterday. So look at this, you know, phenomenal rally. We have had that pullback because this repricing, this choppy trade as the market repriced Fed rate expectations, Fed rate cut expectations. But we had this AI optimism and upgrade from Apple that's boosted the Nasdaq above this level to a fresh all-time high. We're going to be bringing 17,500 into focus. Support can be seen there at around the 17,000 level, and below that I'll be watching for the 20 SMA around the 16,750. If we can get sort of a breakdown below those levels, then watch out for 16,170. Dow Jones hasn't been performing as well as the Nasdaq. It just doesn't have the same tech components that we've seen on the Nasdaq. So we've not been able to get out of this range. Dow Jones is still very much trading within a range. It's ticking, look, just testing the 20 SMA. And it's going to be, if we can manage to stay above that, then we'll be looking for 3,800. 37,800, which is the January high and the December high that we saw at the end of December and the beginning of January. On the downside, be watching out for this level here around the 37,000 mark on the downside. If we get a breakdown below there, then that could spark a deeper sell-off. And we've just got time for one more. We're going to squeeze it in. Let's have a look at gold. Oops, a daisy, hang on, bear with me. So as I said, you know, we've had this Fed repricing. That's been the big story of this week. And as the market's been repricing, we have found a base here for gold, found support there at the 2001 levels or 2000 support, and it has pushed higher since. next levels to be watching for, it's taken out the 50 SMA, it's heading towards the 20 there at around 20.43. So that's going to be the next level I watch out for. Above that, I'm going to be looking around for around 20.54, which is this support, resistance here, and also the rising trend line resistance as well. You know, if we get on the downside, it'll be a move below the 2000 level, which could spark a deeper sell-off. So that's all from me. I hope you've enjoyed it. And if you do have any questions, then please pop them in here, or also we do feel free to tweet me as well at Fiona City Index. Thank you very much for your time, and I look forward to seeing you next week.